Okay, let's jump right into this deep dive. We're tackling a really important topic today based on this piece. Dividend cut alert. High yield dividend growers getting too risky.
Yeah, this one hits home for a lot of people. Anyone relying on investment income or, just like seeing that dividend check.
Exactly. That little warm, fuzzy feeling.
Right. And there's a powerful pull towards high yields, isn't there?
Yeah.
Especially now. Savings rates are up a bit, maybe, but maybe not enough for your goals.
So you see that 6%, 8%, maybe even 12% yield, and it's very tempting.
Incredibly tempting. But this analysis we're looking at has a pretty sharp warning, specifically for 2025.
It does. It's saying, look, just chasing those high numbers can be really dangerous. Dividend cuts are happening. They're not just theoretical anymore.
And more might be coming, according to this source.
So our mission here is to really unpack why high yield can signal risk, like the source suggests.
And look at some real companies the source points to that have, well, run into trouble recently.
And then, crucially, figure out, is there a way to find safer income opportunities based on their framework?
Absolutely. Think of this as a shortcut, really, getting you up to speed on what could be a major portfolio issue right now.
We'll pull out the key insights from this analysis, help you spot potential red flags, maybe build a more reliable income plan. Sound good?
Let's do it.
Okay, so first up, this pull, this allure of high yield versus the danger underneath. Why do investors keep reaching for 8%, 12%?
Well, the source is pretty blunt. It mentions greed.
Huh.
Or, maybe a bit more charitably, it's that search for passive income, maybe with some upside too. It looks easy.
Looks easy, yeah. But the core argument here is that high yield often isn't a reward. It's a warning sign.
Exactly. A signal of distress within the company. A flashing red light, basically.
Okay, so how do we spot this distress? The source lays out what it calls the big three red flags. What's the first one?
Unsustainable payout ratios. This is a big one.
Meaning they're just paying out too much of their earnings.
Way too much. The source actually gives a number, a threshold, like more than 80% of its earnings. Or worse, more than 100%.
Oh, more than 100%. Wow.
Yeah. When you're doing that, the source calls it a dividend house of cards. There's just no cushion. If earnings wobble even a little.
Poof. Okay, that makes sense. What's red flag number 2?
Negative free cash flow. And this is critical.
Right, because dividends get paid with actual cash, not just the profit number on the income statement.
Precisely. Free cash flow is the cash left over after running the business and investing in it. If that's negative, more cash is going out than coming in.
So the dividend is sort of hanging by a thread.
Yeah, the source says it's walking a tightrope with no net. The core business isn't actually generating the cash to support that payment.
Got it. And the third red flag.
That's about the balance sheet, rising debt, and falling coverage ratios.
So companies borrowing money just to pay the dividend?
Yeah, which the source calls desperate, especially now with interest rates higher. Refinancing that debt, it becomes a real problem, a chokehold.
Okay, so those are the big warnings. Payout ratio too high, not enough cash flow, and piling on debt to cover the dividend.
Right, and the analysis stresses this isn't just theory, it names names. Shows companies that have stumbled recently.
Yeah, let's get into those. The source calls it 2025's growing list of losers. Who's on it?
Well, Krispy Kreme, for one. DNUT.
The donut place? Really?
Yep. The source says they suspended its dividend entirely back in May 2025. Reasons: weak earnings, flat growth, input costs rising. That dividend sugar rush was over.
Okay, who else?
Sabine Royalty Trust, SBR. That one saw a really brutal cut, 35%, also in May.
Ouch. Why so much?
Well, it's a trust, so it passes through income. And with oil price swings, reduced production that directly hit what they could pay out. It's variable income by nature.
Right, that makes sense for a trust. Any other sector?
Regional banks felt the heat too. Citizens Financial Group, CFG. The source says they cut by 22% in Q2 2025. Why? Increased capital requirements, deposit costs spiking. The pressures on regional banks we've heard about.
And the market reaction.
Not good. The stock apparently tanked 18% in just 1 week after that news. Shows how jarring a cut can be for investors.
Wow, 18% in a week?
Yeah.
Yeah, that's significant. Anyone else flagged?
Whirlpool, WHR, is mentioned as being under pressure. The source expects either a cut or at least a freeze and review by the end of 2025.
Because
Stagnant revenues, shrinking margins, just the business fundamentals looking weaker.
these examples really show how fast that dividend can disappear when the business struggles.
Absolutely. Which leads to another really key point the analysis makes.
What's that?
The trap of dividend growth masking underlying business decay.
So just because a company's been raising its dividend for years doesn't mean it's safe?
Not automatically, no. And the source uses Walgreens, WBA, as a, quote, textbook example of this.
Walgreens. But they had that decades-long streak of raising dividends.
Good.
Dividend aristocrat, right?
They did, which sounds super safe. But then, Jan 2024, they froze the payout. And now, in 2025, the source says a cut is widely expected.
So what went wrong?
The core business was struggling. Declining earnings, cost overruns, closing stores. The dividend growth sort of papered over those cracks for a while.
Giving this illusion of health.
Exactly. While the actual foundation was shaky. And the stock price reflects that, down over 50% from its 2021 high. The market eventually figured it out.
So the dividend history didn't protect it.
Not when the fundamentals eroded. Another one mentioned is Diversified Energy Company, DEC. Slashed its dividend 40% in early 2025.
Reasons.
High interest costs, hedging losses, weak gas market, a few things hitting them.
And was that a surprise cut?
Well, the source argues the writing has been on the wall since 2023. You can see rising debt, shrinking margins.
Yeah.
The signs were there before the big cut happened.
Okay, so these aren't just isolated incidents and maybe not always complete surprises if you're looking closely.
Right. And to add weight, the source points out that professional analysts are warning about this too. It's not just this one analysis.
Okay, like who?
It mentions a Barron's cover story. They analyzed dividend stocks, grouped them by yield level into quintiles.
And what did they find?
The highest yielding group, quintile 5, actually had the worst historical returns and the most dividend cuts.
Wow. So chasing the absolute highest yield, statistically, hasn't paid off, according to that study?
Seems that way. It was quintile 2, modest yields, but solid coverage metrics that actually performed best. Quality over just quantity, basically.
That really drives the point home.
Yeah, and Credit Suisse apparently warned about this too back in April 2025, urging income investors to take a hard look at their holdings.
Did they give any guidelines?
They did. Suggested looking for debt to EBITDA under 3.0x.
Okay, so debt not too high relative to earnings.
Right. And free cash flow covering the dividend by at least 1.5 times. So $1.50 in cash for every $1 paid out.
That's a solid buffer.
And trying to avoid companies, too, exposed to really cyclical ups and downs in revenue, their conclusion was pretty stark. Yield without sustainability is a mirage.
A mirage. Okay. So lots of warnings, lots of examples of things going wrong. Does the source offer any hope, any safer alternatives?
It does, thankfully. It shifts gears to say, look, not all high yield is bad. You just have to be really selective. Focus on strong fundamentals.
So who do they highlight as potentially safer bets?
They give a few examples of companies with what they call reasonable yields with solid growth profiles. One is UGI Corporation, UGI.
UGI, what do they do?
Utility and midstream energy. Yield around 4.1%. And get this, 37 straight years of dividend growth.
37 years. Okay, that sounds more like it.
And the source notes manageable debt, diversified business. Calls it boring, but in a good way. Suggests stability.
Boring can be good for income. Who else?
EPR Properties, EPR. That's a REIT, a real estate investment trust. Focuses on entertainment and experiences, movie theaters, resorts, things like that.
Okay, what's the yield there?
Around 6.7%. And the source notes they recently raised the dividend. Occupancy is strong post-COVID. That hike signals confidence from management.
Interesting. A higher yield, but backed by recent positive action. One more.
Clearway Energy, CWEN, yielding about 6.0%. They're in renewable energy assets.
Renewables, okay.
Yeah, and the source likes their dividend growth target, 5-8% a year, long term. Plus, they have contracted revenues, inflation protection in those contracts. Things that suggest stability.
So these examples seem to have decent yields, but maybe more solid foundations than the ones that got cut.
That's the idea presented, yes. Which leads to the next step. How do you build a portfolio around this thinking? You need a framework.
Right, not just picking individual stocks. The source uses these fictional portfolio case studies, which I found pretty helpful.
Yeah, they illustrate the outcomes clearly. Portfolio A is the cautionary tale, the high-yield trap.
Loaded up with some of those troubled names.
Exactly. SBR, WHR, CFG, ZIM. High starting yield, 8.5%. But the result?
Disaster. Down 23% in a year. 3 out of 4 cut their dividends.
The lesson, according to the source? Chasing those unsustainable yields can wreck your capital and your income stream. Lose-lose.
Okay, then portfolio B, balanced income. What's in there?
Some of those safer names we just talked about.
Yeah.
UGI, EPR, CWN plus 3M. Yield was lower to start, 4.8%.
But the performance?
Positive, up 5% over the year. And crucially, 0 dividend cuts among those top holdings.
So lower yield up front, but better total return and, importantly, reliable income.
That's the takeaway. And finally, Portfolio C, defensive dividend growers.
Who's in this one? Sounds conservative.
Yeah, think big, stable companies. J&J, ADP, NEE, PP. Lowest starting yield, just 2.9%.
But how did it do?
Best performance overall, up 8% in the year. Plus, solid expected dividend growth rates, like 6–10% per year.
So lowest initial yield, but highest total return and safety. Good for the long haul if you want income to grow.
Right. These cases really hammer home that headline yield isn't everything. Sustainability, driven by business health, is key for income and returns.
Okay, this is practical. But what if someone listening already owns a stock that just cut its dividend? Or looks like it might.
Yeah, that's a tough spot. The source gives some advice here. First thing, try not to panic sell immediately.
Easier said than done, maybe, but okay, don't panic.
Yeah.
Then what?
Step back. Ask some hard questions, like the source suggests. Is the underlying business still okay long-term?
Or was the cut maybe strategic, like preserving cash to invest in something important?
Exactly. Are they talking about bringing the dividend back later? You need to assess the reason for the cut.
So based on that assessment...
2 paths, really, according to the source. Path 1, reassess. If you think the company's still solid, the cut was temporary, maybe you stick with it. View it as a reset.
Okay, and path 2?
Redeploy. If the cut reveals deeper problems, bad management, flawed business model, then maybe it's time to cut your losses. Sell and reinvest that money into stronger companies using those quality checks we talked about.
Makes sense. Reassess or redeploy. Now, how do we avoid getting into that situation in the first place? Any tips from the source on monitoring for potential cuts?
Yes, definitely. They list a few things smart investors watch. First, keep an eye on those payout ratios. Track them quarterly.
Using resources like Seeking Alpha, Simply Safe Dividends, places like that.
Right. See if that ratio is creeping up towards that 80% or, heaven forbid, 100% level. That's a warning.
Okay, what else?
Watch the earnings reports really closely, especially the cash flow statements. Again, cash pays the dividend. Is free cash flow declining or negative? Big red flag.
Got it. Cash flow is king.
Absolutely. Also, set up news alerts for your specific stocks. Operational problems, slowing growth, management shakeups. These often happen before a cut is announced. Stay informed.
Be proactive, not reactive.
Exactly. And finally, diversification. Don't put all your income eggs in one basket, especially not one sector like, say, energy trusts that are all exposed to the same commodity risk. Spread it out.
Good advice across the board, really. So, wrapping this up, this deep dive into the source, what are the absolute key takeaways for income investors right now?
I think the biggest one is high yield often means high risk. Don't be seduced just by the percentage number.
You need that checklist. Look at the payout ratio, look at the free cash flow, check the debt levels, evaluate the safety.
Right. Diversify your income streams. And don't be afraid to admit when a company's story is broken.
Don't feel you have to hold on forever just because it used to be a good dividend payer.
Precisely. The source's conclusion sums it up well. Yield is not a free lunch.
Yeah. If you want reliable income, you need to focus on quality, sustainable businesses.
It really boils down to that. Quality matters.
And that final thought the source leaves us with is pretty powerful, something for everyone listening to consider about their own approach.
Yeah. The only thing worse than a dividend cut is not seeing it coming.
Ugh, that's a good one to reflect on. Are you watching the right things in your portfolio? Are you looking for those red flags we talked about?
Hopefully this discussion, based on the source's analysis, gives you a framework to do just that, to see the potential trouble before that dividend disappears.